Hello there. Welcome back to Cost and Management Accounting N6. This video, we want to look at the question paper of June 2024. And we're going to look at the question 3 on preparation of the contract account. So we are going to go through the question. The question reads, Power Builders Construction Private Limited is currently working on two contracts. Details of the contracts are as follows for the year ending 30 November 2021. So we are given details of the contract whereby we are giving a column for contract PBC 100 and contract PBC 200. We have got a list of balances that we are given that you need to go through before you answer the question. So beneath that, we give the required section whereby we have got our questions. So you'll see that let's just try to see what we have in terms of the question part. 3.1 reads prepare the contract account for contract PBC 100, and it has got 11 marks. And this is the question that we are going to look at in particular for this video. So we go up. We go up there. You'll see that we have our contract PBC 100 in the first column. So that's where we're going to prepare a contract account. So remember, when you're preparing a contract account, we have got the debit side and the credit side, and we are saying on the credit side, we are going to put our material transferred. Material on the end also goes on the credit side, and we've got your contract price on the credit side, extras on the credit side. We are given the balance of machinery at the beginning, at the beginning and at the end, as we are given here. We have got balance of machinery, which is 30/11/2020, which is at the beginning, and then we've got 30/11/21, which is at the end. So the one at the beginning, you are supposed to put it on the debit side, and at the end, you put it on the credit side. And then obviously, we are going to have our provision for latent defects here, which is our 15%. And we are saying, we are going to say 15% of the profits, of the expected profit, whereby we are going to calculate the balancing figure that is going to be our total expected profit, and then we are going to say 15% as for provision for latent defects. We're going to say 15% of that balance, and then we reduce that 50%, and then the remainder will be transferred to the profit and loss. So basically, we are saying of the expected profit, we'll be saying 15%. And then for the ones that is supposed to be transferred, the profit and loss will be now 85%. Because if you say 100 minus 15, or 100% minus 50%, you get your 85. So it means that the balance to be transferred, the profit and loss will be 85%. So this is exactly as what we are going to do. So let's go to our answer section. So you see that this is our contract account. This is our contract account. So we are just going to transfer our figures there. So what we are going to do, we can go through the balances and try to see what we have. And then obviously we now, after getting our balances, we transfer them to the contract account. So let's go there. Remember, we are looking at contract PBC, and we start from contract price there, which is our 20 million. And we'll see that our contract price is going to the credit side, so we can just transfer it to the credit side. So we go to the credit side, and we are saying our contract price, and the amount that we have is 20 million. Right, and then we go to the next item that we have on the list of balances. And then I believe that we've got wages 2.5 million, which is 2,500,000. We are saying our wages goes on the debit side. So here we are saying wages on the debit side. And then we have got a 2,500,000. So we are saying 2,500,000. And then we go to the next item. From 2,500,000, we go to material issued, which is 3,750,000. And material issued also goes to the credit side. And then after materials issued, we've got manufacturing overheads, which is 900,000, which goes to the debit side again. So we're going to the debit side, we're going to put our material issued and then manufacturing overheads for the respective amounts. So we come here, we're saying material issued, and then the amount that we have is 3,750,000. Then we also have manufacturing overheads that we've identified. Manufacturing overheads. So this is manufacturing overheads, and then the amount that we have for manufacturing overheads, we identified it as what 900,000, 900,000. So this is what we have. Then we go beneath manufacturing overheads to see what we have. We have material transferred from contract PBC 100 to contract PBC 200, and the amount is 89,000. So obviously, when it is transferred from PBC 100, it means we are going to credit it in PBC 100, and then we are going to debit it in contract PBC 200. So the consent account, according to requirement of the question, is PBC 100. So we are going to go to the credit side of PBC 100 and put our 89,000 as material transfer. So we can go there. So we are saying material transferred, and we put 89,000. So we are here, we are saying 89,000. And then after that, we go to, after material transferred, we've got machinery balance at the beginning. We say that at the beginning, balance will go to the debit side, which is 1,200,000. And then at the end, we go to the credit side, which is 900,000. So we're just going to post as it is. We go here, we are saying machinery at the beginning. Machinery at the beginning. And they are saying the amount that we have is 1,200,000. Then you go to the credit side. That's where we have machinery at the end. So we are saying machinery in the end, we're having 900,000. Then we go to after that we go to a material on the hand. We've got 45,000, and it has to go to the credit side. So here we are saying credit with the material on the hand, and then we can try to post it. I can post it to the credit side. That is 45,000. We'll go there. So you're saying material on the end, the amount that we have is 45,000. So you're saying 45,000. Then we can try to see what do we have after material on the end. So after material on the end, you see that we've got certified work, and certified work doesn't qualify in our contract account. We leave it. Total expected contract cost again is just representing all the expected costs. So we can leave it just the total, and then we got uncertified work. Also, we don't include it in the contract cost. Then cash received again, we don't include it. Then of course extras, we are going to put them on the credit side is 5,000. Remember, extras are going to increase our contract price. So we go to the credit side and put our extras as 5,000. So we come here and we are saying extras. We have 5,000. And so this is what we have. And then I think we've exhausted everything. You can just maybe cross check. Right. We are now left with provision for latent defects, which is going to be 15% of the expected profit. So we are going to put there provision for latent defects, and we are going to make a calculation after we have calculated the balancing figure. So we can just come here and say By mere comparison, we can see that the credit side here it's a greater side in terms of total. So if you add the total of this credit side, I would see that we are going to get 26 million in 34,000. And then you add the total of the debit side, you'd see that you are going to get 80 million 300 8,350,000. So obviously this is what we have, and then you calculate the difference between the two totals, whereby you are now saying 26 million and 34,000. You subtract 8,350,000. You see that the difference that you are going to get is going to be 17 million 684,000. So this is the difference, which is the expected profit, that is the balance that is on the debit side, because the debit side has got the smaller total. So the balance figure will come on the debit side. So this is the balance figure that we are going to calculate the provision for latent defects. So if you come here, we have got our provision for latent defects are being our 15% of profit. So the 15% now, we are now saying, remember the figure that we got for the expected profit is 17,764,000. So to get provision for latent defects, provision for latent defects is equal to 15% as a decimal, and it becomes 0.15. We can just say as 15 over 100, which is 15%, times our profit, which is 17,684,000. Then we get the proportion of provision for latent defects, which is going to be your 2,652,600. So this is going to be your provision for latent defects. So this is the figure that we're going to represent here in the contract account. So we come here, we are saying provision for latent defects. Let's just maybe try to make it clearer. Provision for latent defects. And we got our amount of 2,652,600. And then the other balance that is now remaining will go to profit and loss. So having calculated it like this, we are now saying the remaining balance go to the profit and loss. Then let's try to calculate it, the profit and loss figure. So it's now very simple. We'll say our profit and loss figure, calculation of our profit and loss figure. Profits are, let's just say profit or loss. So we are going to say our total profit, expected profit is 17,684. Then we subtract 2,652,600. And then you calculate it like that, so you're going to get a figure of 15,031,400. So this is the figure that is supposed to be transferred to the profit and loss. So we are just going to put them those two balances, provision for latent defects debit side, and then profit and loss figure that is being transferred again debit side. Remember, we are trying to balance this account. So here now we are saying 15 million and 31,400. So this is what we have, in such a way that now when we are balancing this account, we are now putting our double lines. There's no need to stress there. We are supposed to have the same total. Remember, the greater total will come in between the lines, both sides of the two sides. When you initially calculated totals of the debit and credit, we got 8,350,000 on the debit side, and got 26,034,000 on the credit side. And obviously, the credit side is the greater total. So it has the figure that has to come in between the double lines, both sides. If you come here now, we are saying 26 million and 34 So the same figure will come debit side in between the double lines, 26 million and 34,000. So with that, we are done with the contract account. So the issue is on trying to find out about the balances, which is a very simple issue. You just have to add the total of the credit and the debit. And the greater total obviously will be the credit side. It comes in between the double lines. And then the difference that we've got now between the total of the credit and the debit becomes the total of balancing, which is the total expected profit. And then we calculate the proportion of provision for latent defects that are given in the question. In this case, we're given it as 15%. You say 15% of the total expected profit, then you get the proportion for latent defects. Then the proportion is supposed to be transferred to the profit and loss is just the difference between the expected profits minus the provision for latent defects. And then you get to 50 million and 31,400. Then we are done. So this is what we have, guys, according to this video on the preparation of the contract account. Let's meet again in the next video. As for this video, I'm out.